Welcome to the InterMarket analysis video update. I go through a number of different areas in this particular video, and I prepare it once a week where we look outside of the S&P 500 to see are we getting any clues as to what's ultimately happening with the S&P. And this is being prepared for Monday, August 25th. Now, first area that I go through does apply to the S&P 500. We look at valuation on a historical basis and on a forward-looking basis. And of course, we've been getting lots of extra charts about valuation, how the market's overvalued, whether you look back, whether you look forward. And kind of the conclusion I've reached is valuation doesn't seem to really matter until it does. And that's very open-ended. A lot of times we'll be watching that the market is overvalued. That can last for many years at a time. And then all of a sudden we hit a difficult time in the market and then price comes down. It lines up more with the earnings that have been coming out. And then we get a little bit closer to not being as overvalued as we were before. So we can't really use this for timing, but it's something that we've known about for quite a while. We look at it in a number of different ways in this video, but it's nice to know, and it kind of justifies if we see a pullback, but we need to use other tools to get a better valuation of the market itself. Okay, and we also look at growth versus value. Now, we're not really seeing any changes this week. Growth is still outperforming value, but we're seeing a little bit of a shift more shorter term, and I'll go through that. We look at inflation. There are some concerns coming back into the market now, especially after the PPI report came out week before this week that just ended, came out on Thursday, and that shocked the market. And we started to have some problems since then. The market was thinking, well, we're going to have a 50 basis point cut when the Fed meets in September. And then that was justified after CPI came out. Then when PPI came out, it's like, okay, there's some inflation pressures here. Now we're going to get another read in the upcoming week. We're going to get GDP again. That's the second time we'll see this number. That has an inflation component. And we're going to get the core PCE on Friday. And that's the one that the Fed really pays attention to. If that comes in hot, that could really pressure the market. If it comes in more market friendly, that could really help the market. But we look at some charts just on an ongoing basis outside of these economic reports to look at inflation. We look at other markets, sometimes what's happening in the oil market or the gold market or interest rates. We want to keep an eye on those things. Then I go through the 11 sectors for the S&P 500. We look at a chart of the sector all by itself to see how it's looking. And then we do a ratio with the S&P 500 to see how is it performing against the broader market. We keep an eye on a number of different indexes. We can get some insight from that. Then we look at correlations between different markets. We look at stocks to bonds, stocks to interest rates, and just to see are we really getting some kind of clues about the market that way. We look at some very long-term trends. I do show some weekly charts, but this section 8 here mainly looks at longer term trends. And then at the very end, I go through a positive and a negative list. Now, there's really no changes if you watch these videos on a regular basis with the longer term. I use moving averages and when they cross over. The only thing that's really negative right now is the dollar. And that's what's really been helping stocks to go up is a weaker dollar. Stocks tend to like that. Now, the dollar, if it starts to bounce back up, if interest rates start to go back up, that could put some pressure on stocks. Okay, so valuation here, and you can see the red dashed line, that's where we would be considered to be expensive. And that's right around almost at the 4,300 level, a little bit above that here, just below 4,400 for the S&P. Well, we're above 6,400. So we would have to have a pretty significant decline just to get down to being expensive. Now it's like we're really, really expensive, but you can see we spend a lot of time above this red dashed line. And we have now for a number of years. We came back down when we had the bear market in 2022, and then we just dropped a little bit below. But you can see during that time, the earnings started to drop off as well. So, yeah, okay, the market's overvalued. And at some point that may matter. We're just not exactly sure when. This also shows that same thing, goes all the way back to 1980, and then different valuations. And you can see we spend a lot of time looking overvalued. Then Robert Shiller developed a more smooth approach using earnings over a 10-year period of time. Also, very overvalued here, 38.96. The median and the mean, which has been this now for quite some time, is between 16 and 17. So we're over double what the median and mean would say the price should be. And the market looks forward though, and even this way, we're looking expensive as well. As of August 8th here, then so this is a little bit outdated, but we've been going up. We have the purple line here. This is the mega cap 8 coming in just under 30 at 29.6. Okay, and we still use that 10, 15, 20 point scale to measure this. We look at the S&P, which is the red line, coming in at 22.3. Okay, so we're well above that 20 level. Now, we're a little bit more fairly priced when we look at the mid caps and small caps, and they had a pretty good week. They like what Jerome Powell said on Friday, that he's open to a rate cut. That's how the market's interpreting what he said. And they thrive more in a declining or lower interest rate environment. And so we saw them have a pretty good week. But we've seen this before. There's been a lot of false starts over the last few years with the small caps and mid caps. And then things start to shift and look a little more negative, and then they give those gains back. Where on a forward-looking basis, we look at the S&P 600, and that's coming in at 15.2. That's right about the fairly priced level. The only problem with this is a lot of people look at the Russell 2000 small caps, which I look at, but I don't study as much as I used to. It's coming in well over 20. If you look at the Russell 2000 forward PE ratio, it's considered expensive. Where this one is more fairly priced. So there's some discrepancy between the two. And then the mid caps are coming in at 15.9. So from a valuation standpoint, it's like, yeah, maybe this is a time to look at small caps and mid caps. But you can see we've been around this level, even below this level. And it always looked good from a valuation standpoint. They're just not performing all that well. So that can lead to a lot of frustration if you use that approach of valuation when to get into either indexes or individual stocks. This looks at the global valuation range. And here's the US coming in at 22.8 at the time. This goes back to 1987 compared to the rest of the world. And the rest of the world tends to be more fairly priced, even a little bit underpriced here in Spain, emerging markets, the UK, Italy. But the US market is the biggest market, and it's where most people go, whether you're in the US or even outside the US, to do most of the investing that takes place. Then here's the world by sector, and we still have tech. That's the big growth area coming in at 27.7. We also have growth. That's what really drives the market higher, also overvalued. Discretionary, that includes in the US anyway, things like Tesla, Amazon, that's also above 20. And we have industrials, which has done pretty well in 2025. That's also over 20, as well as communication, another growth area. And then we start to drop down a little bit, and then we get a little bit more defensive in these areas. So the stocks that really promote growth, that really drive the indexes up, yeah, they're overvalued. And if they start to pull back, and we're in a weak seasonal time that still has yet to develop, I've been waiting to see if something's going to develop on the weaker side since the middle of July, and it just hasn't come about. In fact, on Friday, we set an all-time high with the Dow, and we're close with the S&P, we're close with the Nasdaq and Nasdaq 100, and we're improving even with the mid caps and the small caps. But now we need to see more follow through. So this could even become a greater on a valuation basis to show that US stocks and IT stocks and growth stocks are even more overvalued. Then this looks at the PE 10. This smooths it out a little bit, and it shows how US stocks are much more expensive when compared to developed markets and emerging markets. All right, then we look at growth versus value. First, I look at just growth by itself. Doing okay. It's coming back. We hit August, and we're seeing a little bit of a pullback in growth. It's not turning negative, but we are declining, and we came down to the 50-day moving average. And it appears that the market is becoming more defensive, meaning that it's likely getting ready to decline. Now, that was really thrown a curveball in Friday's session because we were coming down with growth and a lot of stocks and even the indexes were starting to decline. And then Powell came out with his speech, and then there was this big up move where we didn't really see that big of a change. Value is still doing well. Now, growth outperformed value on Friday, but we need to see, are we going to shift back more to a growth environment, or was that just an emotional response to what Powell said? Because the market was selling the rumor, and then when the news came out and it was actually pretty good, they bought the news. So we did bump up. We were up over 2% just in Friday's session and bounced off the 50-day moving average. Then we look at growth, or excuse me, value, and this, look at this. You usually don't see this, especially on an up day like Friday. It was up over 2%. So this suggests that, is the market getting into some value stocks? Stocks that some even go up when go through these declines, but they tend to hold up better, where growth stocks tend to go down faster. But this is a little bit of a warning sign that we have been going up with value, and then we saw a big up move in Friday's session. But when we look at the ratios between the two, you can see we are pulling back, but growth is outperforming value. But we've come down and actually dropped below the 50-period moving average with this ratio. That's a market that it appears to be getting more defensive. Now, we could turn around and go back up and reclaim this and show more strength with this ratio, but this is what has been happening. And even with the update on Friday, it's still happening. Then we look at an inverted version of that same ratio where we've been showing how value is underperforming growth until we got into the early part of August, and now we've been seeing value starting to outperform growth because August and September are historically weaker months for the markets. Then this is another growth to value ratio. Using some ETFs, it was really outperforming. Now it's been pulling back. Value's been underperforming, but now it's showing a little bit of strength. Not enough to change the overall trend, and this could be more short term if it does play out where we do see a decline in the market. It's not really shifting the longer term relationships, at least yet. And here's another growth to value ratio, looking at some indexes where we've come all the way back down and fallen a little bit below the 50-day moving average. We're a little bit above the 50-day moving average when we're looking at an inverted version of that same study. And this is one I show in the daily videos, growth versus value, coming back into the top end of the rainbow, not falling apart, but showing that there is a shift going on. Then this is that same thing, but inverted, showing how value's been coming on and showing a little bit more strength. And we have been seeing a real drop off here with small cap growth to value. It actually was doing well as we were coming up out of the April lows, and then has been going sideways ever since then, and is now starting to drop below both moving averages. Also seeing a little bit of a tick up on Friday, but when we look at S&P growth to value, also bigger picture positive, but seeing some shifting going on in the market, and the mid caps also falling below its 50-day moving average. Then we keep an eye on inflation, and this is a monthly chart where you look at the monthly chart of the CRB index, we're still above the advancing moving average. That's not really going up with any real conviction, but it is going up, and that can be inflationary. What's causing a little bit more concern is that we crossed above the moving average when we look at an inflation versus deflation ratio inside the CRB index. And this is a little bit of a concern. Now, we saw this well before PPI came out, but this is feeding into part of a scenario that, okay, we need to keep a closer eye on inflation. Here's the daily chart of the CRB index, where it's been going along pretty much sideways, and it bounced up in Friday's session after dropping below both moving averages, but not showing an awful lot of conviction here with the daily chart. And we are in an uptrend when we look at the Baltic Dry Index. We tend to see this as inflationary when it's going up. And we look at inflation expectations. Now, this is not really changing all that much. We were coming up here as we were going throughout 2025, and now we've kind of leveled off. So this is not really showing that there's any concern according to this ETF. And we're kind of just chopping around lately after declining when we look at an inflation expectations to tips ratio. Tips outperform when inflation and interest rates are going up. We're not really seeing that reflected here in this chart. Then we keep an eye on some other markets where we've been bouncing back up with aluminum, but we are still in a downtrend. And we're continuing to drop off with corn. That's in a downtrend. And wheat is also in a downtrend. Fertilizer has been going up, but not really spiking like it did back in 2022. But this could be a little bit inflationary here. Lumber is in an uptrend, but not really showing an awful lot of conviction. It came down to its 200-day moving average and is holding above that currently. And oil's actually been declining. And I mainly follow this for inflationary purposes. And when it really goes up, it tends to be more defensive. But this is also a geopolitical thing that we keep an eye on because a lot of oil comes out of the Middle East. And if there's problems over there, which there always are, oil can really spike up. This was when the Russia-Ukraine war started, and then we've been able to come back down. Now we're still in a downtrend here, but we do want to keep an eye on this. And we look at a gold to oil ratio, not really moving all that much. It's oil has been in the upper and now it's around the mid 60s where gold has just been going sideways. And we look at a correlation and it's neutral right now, but it had been going in opposite directions where we saw oil going up and then the 10-year yield actually coming down. They're actually getting closer to going in the same direction, even though that hasn't really transpired on the chart here. But they were going in opposite directions, and now we've worked back to a neutral relationship between the two. And then here's gas, it's just kind of humming along, not really seeming all that inflationary, even though it is in an uptrend. And heating oil has been coming down as well. Natural gas is in a downtrend, and diesel, which had been going up, is now starting to come back down. So, not really seeing any inflationary pressures here or in the CRB daily chart itself. It's longer term that we're seeing a little bit more of this unfold. Now, copper was really doing well, and we use this like a barometer of the economy. When copper is in an uptrend, that tends to bode well for the economy going forward. Then some news came out concerning the tariffs, and copper just really took a dump here. Not enough to switch the moving averages over, at least longer term, with the 50 across the 200, but we're well below both moving averages. And this is a little bit of a warning sign for the economy. But then we have another chart that I look at later that I also use as a barometer, and that chart's looking fine. Copper to gold ratio really coming down now. This means copper has been underperforming gold. And it's not that gold is doing great, it's that copper has been declining, and that's what's causing this ratio to go down. We're also seeing a real drop off here. And I also put the 10-year and 2-year yield on this, where we've been kind of going sideways with the 10-year, actually drifting lower here with the 2-year as the copper to gold ratio has been declining. And this is gold. You go back to the first part of April, about when stocks really started to come up out of their lows, and we've been just kind of looks like a machine gun took this here, and just it's just spotty all over the place, but ultimately not really going anywhere with the gold ETF. Saw a little bit of an up move on Friday with silver, and it's still in an uptrend, but not back to its recent all-time highs. Then we look at a gold to silver ratio. It's been pretty choppy lately. That doesn't mean that it means that gold and silver, not one's really outperforming the other. And then we plot the US dollar index here, and there's a fairly strong correlation between the ratio on top and the dollar index. And this has been coming down for the most part as the dollar's been going down, and that's why we're seeing a pretty strong correlation lately. And the dollar, it reclaimed its 50-day moving average. Now it's back down below it. On the daily chart, it's continuing to be in a downtrend. It's also in a downtrend on the weekly chart. And we see the euro going up as the dollar's been going down. Now, the Japanese yen has been more or less sideways. The dollar's been performing a little better when compared to that. But then here's the euro again, and then showing how it's been going up as the dollar's been going down. Then I break them out. This is where we see a real drop off here with the yen to the dollar, but it's still in an uptrend. But then we get over to the European currencies like the euro, and we were seeing some weakness here, but then it really shot up in Friday's session. And we are in an uptrend and pretty much hanging around the 50-day moving average. Also starting to go sideways with the British pound, but it's still in quite a solid uptrend compared to the dollar. Now we switch over and look at some indexes. Now we did see an improvement, and this can also suggest that the market is becoming more defensive. We have the weighted version of the S&P, which is the bar chart, and then the red line, which is the closing value of the equal weight version of the S&P, where all stocks count the same in the calculation. we saw it really move up. Now, the S&P weighted index, it was up 1.52%, but we saw a really big jump up here with the equal weight version without the mega caps and the really big companies that really drive the indexes higher. They didn't really participate on Friday. It was the rest of the stocks in the index that helped show some improvement with this. Now, that can be positive. That just means that there's more stocks in the S&P that are participating in the upward move. That can also be negative, meaning that, okay, the S&P is composed of growth and value. Growth didn't, I mean, it did good and it kind of outperformed value on Friday. And the bigger picture is that it's outperforming, but a little shorter term, we're seeing more value is starting to outperform growth, and that could be more defensive. And we look at a ratio between the equal weight and the S&P weighted version here, where it had been coming down and then it bounced up on Friday. But the bigger picture is that the equal weight has been underperforming the S&P. And that tends to be positive. That means the big stocks in the bigger picture, going back all the way to 2023 here, they have been outperforming the equal weight index. And we look at stocks to commodities here, and stocks are still outperforming even though they've been pulling back lately. This is an inverted version showing how commodities are underperforming. So longer term, we're seeing some issues here, but on these daily charts, we see a little bit of a bounce here, but it's nothing that's really shifting the overall climate between stocks and commodities. And this is another thing where the Nasdaq 100 is really underperforming the S&P 500. The Nasdaq 100 is growth and it's been outperforming, but see what's been happening lately as we've been coming down? That suggests that the market is becoming more defensive without changing the bigger picture, which means that we might go into a decline at some point. Also, the big stocks in the S&P 500, that's the S&P 100. The S&P 100 has really been outperforming, but lately starting to pull back. And the Nasdaq is outperforming, but pulling back a little bit when compared to the S&P. So this is growth, and this is positive. But the fact that we're seeing some recent weakness here, we just want to keep an eye on that and see if it continues. And this is something that's been really developing going back to the last spring in 2025, where the Nasdaq 100, those are the big growth stocks, they have been starting to underperform the rest of the Nasdaq. Again, that could be positive in that we're seeing more broad participation by the rest of the Nasdaq. When it outperforms, that's when we see this ratio going down. But it's the bigger stocks that make up the Nasdaq 100 that really drive the indexes, and they've been starting to lag behind here. But we look at mega cap growth pulling back a little bit, but still in an uptrend. So we haven't really switched that way, and we're looking pretty solid here. Didn't set an all-time high on Friday, but it is pulling back even though it was up on Friday. We've been seeing this more defensive shift over the last few weeks. And we're seeing that here, the mega cap growth versus the equal weight coming back down all the way to its 50-day moving average. So we're trying to figure out, was Friday just an emotional response and then we'll come into the next week and the market's going to be more defensive, meaning that we could see a decline? Because the S&P is also dealing with some pretty significant overhead resistance, as is the Nasdaq and Nasdaq 100. Small caps coming on a little bit here, but a lot of damage has been done, and we're going to have to see a lot more of an upward move for the small caps to start outperforming the S&P on a consistent basis. And then we see that same thing. Small caps S&P have been going down, flattening out at the end of 2024, trying to break out a little bit here, but we've broken out before only to have it turn and go back down. And then we can see here, this is the S&P 500 in blue. And still doing okay with the robotics and AI ETF. We came back down into the rainbow, kind of chopping along sideways here recently, but underperforming when we compare this particular ETF with the tech sector. You would think this would be outperforming. Robotics, AI, that's all the buzzwords. But there's another one that I show later on that actually looks a little bit more positive. And then the Dow Jones Composite, which is the Dow, which has set an all-time high on Friday. The transports, which are showing some improvement, and utilities have been fairly strong lately. And so this is still looking pretty good. We're not back to the previous all-time high, but we are in an uptrend here. And then small caps to tech, bouncing back up. But the bigger picture is that small caps are continuing to underperform the tech sector. And then we look at the semis. they were starting to outperform, then they pulled back. They had a pretty good day on Friday, but not really showing an awful lot of consistent conviction. We're not seeing a real upward move or downward move right now. But I look at this every day, and if this really starts to move one direction or the other, I bring it out in the daily videos. And the low volatility. We are seeing a little bit of a pickup here. They've been going sideways for the most part, but starting to break out just a little bit. These are more defensive stocks, toilet paper, toothpaste, stocks that hold up better when the market is going through a decline. But here, the bigger picture, we're still seeing low volatility stocks continuing to underperform the S&P, but they are starting to bounce back up here. So we're not shifting over to negative. This could be what it's looking like now, if it even plays out this way, is that the market is getting ready to decline. Friday was more of an emotional response. At some point, there'll be a catalyst that sends things lower. We're not able to get above overhead resistance, but it's not going to change the overall picture. It's just going to look like a normal decline where folks are finally going to come in and start taking some profits without shifting things back actually to a bear market type of stance. Now, that could change if we do start to decline. I'll be reevaluating things. That's why I do videos every day, and we'll see if that shifts over and looks more negative. But that's just how things look right now. And then all world, when you take out US stocks, really doing well here. Then you put US stocks back into the mix, not doing so well. And we've been seeing that for most of 2025. Then the energy sector bouncing back up when compared to the tech sector, but in the bigger picture, energy is underperforming and growth is still outperforming more traditional or not traditional, conservative bonds that people traditionally get into. These are improving, even though we've been seeing a bit of a pullback here. But this is still looking pretty solid. Then we look at the tech sector to the 10-year yield. Tech sector has been outperforming, but recently seeing a bit of a pullback. And then the 10-year yield has been underperforming and then saw a bit of a bounce, even though it came down on Friday. Discretionary to staples, this is actually looking a little bit better. Now you can see this ratio was really going down. It started about the beginning of 2025, and when we finally bottomed in April, we came up out of that. It hasn't been showing an awful lot of conviction, but it's holding up a little bit better than some of our ratios have been lately. Staples underperforming discretionary. So this is still more, we call that risk on or more growth oriented. Then gold, again, this has been coming down because the S&P for the most part has been going up and gold has been going sideways. That's why we see this relationship decline here. Same thing with the dollar's been going down and gold has been going up. So we've been able to hold on to a lot of the value of this ratio. And we're doing okay here with the advanced decline lines. It was a pretty solid day on Friday, and so we bounced up with the NYSE common stock, the S&P above its moving average, mid caps as well as small caps. So we're not seeing a real deterioration there. And we did set an all-time high with the Dow, which has not been confirmed with the transports. They've been lagging behind, and they have a ways to go to get back to their all-time high. Well, we're not too far off of the all-time high with the utilities. They set an all-time high, pulled back. And again, this tends to be more defensive, but as I say in almost every video, you could also make this into a growth area because of the huge need for electricity with AI and electric vehicles and all the shifting that's taking place. And really chopping around here, when we look at the Dow to transports ratio, and here are the transports. They've been disappointing. These other red lines are previous possible levels of resistance, and we're just about at one right now. But it's coming back up and improving, but still has a ways to go, where the Dow is now just setting a new all-time high. And seeing this, when we do another ratio between the transports and the S&P, it's really been underperforming going back to 2023. It's starting to flatten out here and it's showing a little bit of strength here, but overall, you go back to last spring and we started to go up, then we came down, but possibly a bottoming process here, but hasn't really switched from the overall bigger picture downtrend that we've been seeing. And we did not set a new all-time high with the S&P. We used that instead of the Dow for a new twist on Dow theory. And we're not back to an all-time high with the NASDAQ. Now, we did set a new all-time high with the equal weight, and that's encouraging. That was a negative divergence that we were seeing. where the S&P was setting an all-time high, but the equal weight version was not. That is showing a real improvement. But that just means the rest of the stocks in the S&P are now being purchased and going up in price, and a lot of those are value stocks where we're not back to an all-time high with the equal weight version of the QQQs. So this is a big bit of a negative divergence. New all-time high with the equal weight S&P, not an all-time high with the equal weight QQQs. And drifting down a little bit here, but still a fairly strong correlation between the S&P and the transports. Even though the S&P's been outperforming, we can see for the most part they have a pretty strong correlated relationship, meaning that they're going in the same direction at the same time. The Wilshire, that's a broad market measure. It set an all-time high on Friday. The FANG index did not. It came down to its 50-day moving average. It's been holding above that level, and these are the really big stocks, but it also had a good day on Friday. We did set a new all-time high with the total U.S. stock ETF, and we were up a little over 4% here with ARK, and we're still above the 50-day moving average. The NYSE composite, which is also a broad market measure, it's setting a new all-time high. All stocks, where most of the real strength are coming from international stocks, not so much U.S. in of the stocks there. Emerging markets are in a pretty solid uptrend. High leverage loans. This is the other barometer of the economy, still above its 50-day moving average. So we're getting a bit of a conflicting signal here where copper hasn't been showing the strength that it was showing before, where here high leverage loans, which are very risky loans, that's still holding up quite well. Bitcoin coming right around its 50-day moving average. And I'm going to be introducing a new chart. I still have to build it here. It's a correlation between Bitcoin and the QQQs, the NASDAQ 100, because I've been doing some studying on that, and there's a pretty high correlation between the two. All right, then we're coming off of recent all-time highs with the Japanese Nikkei index. Micro caps are still in an uptrend and starting to break out above this previous high. That's looking fairly solid. And here's the SMH semiconductor ETF. It came down to its 50-day moving average and it bounced up off of that. And we're coming back up to the upper side of the rainbow after we were falling down a little bit with this SMH ETF. This is the other ETF where AI and tech. This one's a little bit stronger, but it's not back to its all-time highs yet. It's still positive, and it bounced off of its 50-day moving average, but it's been underperforming as we've been seeing the market becoming more defensive. Now, home builders, they really like that interest rates might go down, and we're seeing a pretty strong correlation. Going back up with the home builders ETF, and for the most part, we're strong here with the S&P after we had been declining, and so that would help the market overall. And we look internationally, turning now. This is the KST. This is a long-term oscillator, so it takes longer for this to actually shift from either positive to negative or negative to positive. But we're pretty much flat here in China, starting to turn back up with emerging markets. Europe is actually looking pretty strong. We're turning back up in Japan, but you can see we're still drifting down here in the US, according to this longer term chart. But you look at this, this is a ratio between US and international stocks, still holding up. And this is a monthly chart where we've been seeing more of the weakness on the daily side and even some of the weekly charts. But this, even though it's declining, it's still above an advancing moving average, but we are going down with the percentage price oscillator, a momentum indicator. Then this is just looking at the price of bonds here, just kind of chopping along sideways, not really seeing any big move there. But when we look at the total bond ETF, this is still in an uptrend with bonds based on price. Stock to bond monthly chart, still showing stocks outperforming. This is a daily chart showing how bonds are underperforming stocks, and we've been seeing that for quite some time. Junk bonds doing quite well in an uptrend. Corporate bonds also in an uptrend, but still having a ways to go to get back to its all-time high. And we are in an uptrend with the Pring World Bond Index. And we look at the correlation between stocks and bonds. Slight relationship to go in the same direction at the same time. And corporate bonds also in an uptrend and actually holding up quite well here. Junk bonds here also doing quite well. The junk bond to government bond ratio, this is holding up well. This is not really showing any panic in this area here, but we've been just chopping along when we look at the ratio between riskier and more conservative bonds. Not a lot of conviction currently. And we are establishing this higher range. We've been doing that now pretty much after we came out of the COVID lows. Interest rates are more in a higher range, which is more the norm. What we've been seeing over the last 40 years, that's not normal. The series of lower highs and lower lows, this was a lot of manipulation coming on, the Fed coming in and really lowering interest rates. Well, now we appear to be establishing a higher interest rate range, which would be more of what historically has been seen. Here's a daily chart where we were going up with the yields, and then we really saw them drop in Friday's session. We are keeping an eye on the red line here. That's Japan. That's the 10-year bond for Japan. And if it really starts to break to the upside, this could cause some problems. It was just a year ago. It was August 2024 when we started to break above the 1% level here, and it freaked everybody out because of the carry trade. And a whole bunch of people had to sell that weren't planning on selling, where you could basically borrow things for free and then borrow money for free and then put that money to work. That was starting to unravel. If interest rates continue to go up, are we going to see more of that? And then this shows how bonds continue to underperform stocks. Then we look at some stock to bond ratios. Still holding up okay when we look at the S&P 500 to 1 to 3 year bonds. Also, the S&P 1500 to short-term bonds, looking good there. A broad market measure to a little further out bonds, looking good there. And we did pull back a little bit with the tech to bond ratio, but we're not really falling apart here. Then we look at the volatility of bonds, which has been coming down. That's the move index. And for the most part, the VIX has been declining as well. And we can see that there's a fairly strong correlation between the volatility of stocks and bonds right now. And then we look at the S&P 500 and the 10-year yield. This shows how the S&P is outperforming. In a long-term chart here, this is the long-term bond, still below a declining moving average. And when we do a long-term bond to commodity ratio measurement, this is continuing to decline as well. That's longer term. Not really seeing that as much on the daily charts, a little bit on the weekly charts. Okay, then we look at the different sectors. Here are materials. Above its 50-day moving average, recent golden cross looking pretty good, but not back to all-time highs here with the sector. But when we compare it to the S&P, yeah, it's bouncing back up, but it's still underperforming the S&P. Communication, a huge growth area, looking pretty solid all by itself. But when we compare it to the S&P, it's pretty much been going sideways. We're still in an uptrend, and we got back above the 50-day moving average, but we're not seeing a real explosive growth right now to this overall ratio. Energy, which has been all over the place. And I guess we're trying to form a golden cross here, but we spend a lot of time above and below these moving averages and bouncing back up, but still underperforming when compared to the S&P. Financials, they're setting an all-time high here with their sector. This is looking really good. It's like, I'm going to go buy me some financials. But when we compare it to the S&P, you can see going back to May, this has really been underperforming and consistently underperforming. Now it's starting to bounce back up, but we have yet to reclaim these moving averages yet. We need this to go back up, get above the moving averages, stay above the moving averages, and then eventually switch over into a golden cross. So we're still seeing an overall decline in the bigger picture, and that's a bit of a concern. Industrials doing quite well, not quite back to an all-time high, and they were starting to really underperform. This is when the market was getting a little bit more concerned. Employment was weaker, then PPI came out. We saw a bounce back up here, and they're still in an uptrend, but it would be nice to see more follow through to the upside here. And then looking at the tech sector, this is the big growth area. Has been pulling back, not quite back to its 50-day moving average, and starting to underperform a little bit. These are some of the more defensive things that I've been talking about. Where tech is still strong, it's still in an uptrend compared to the S&P, but it's starting to drift lower, and that could suggest the market is becoming more defensive. Staples, which have been going sideways, starting to break out. This is what folks get into when the market is becoming more defensive, but still underperforming when we compare it to the S&P. It came back up to its 50-day moving average and then got hit a bit in Friday's session. Real estate all over the place, but it likes the fact that interest rates might be coming down, but really underperforming and has been for quite some time when we compare it to the S&P. Utilities holding up quite strong here, but kind of going sideways when we compare it to the S&P itself. Not really outperforming, not really underperforming either. And then we look at an S&P to utilities ratio, and I usually show this in pretty much every daily video, but we've been so choppy lately. That's mainly because of this previous chart. We're not really seeing any conviction one way or the other, so I haven't been showing this chart all that often. Then healthcare, which is more defensive, just getting hammered these days, but seeing a recent bounce back up, trying to get back above its 200-day moving average and bouncing back up here with the ratio, but still in a longer term downtrend. Discretionary, this is looking better, but still a ways to go to get back to all-time highs and still not really performing all that well, still in a downtrend, a lot of sideways action when we compare it to the S&P. And semiconductors, a huge part of growth, doing well. Came back down to its 50-day moving average and so far has bounced up off of that. And we look at the Dow Jones Semiconductor Index, also a bit of a retreat and then a nice bounce on Friday. And we're kind of going sideways now after improving when we look at the semiconductors, which is growth, to Dow, which is value ratio. So this is holding up for right now. And then longer term, we're still looking good with the SOX index. And here's gold just continuing to drift sideways. And now stocks are in second place as far as the best performing asset in 2025. Then we have commodities. The blue line are bonds. We have oil, which is getting back to unchanged. And it's the dollar that continues to be the weakest asset. Then some correlations here going in opposite directions. So if the dollar's going up, that probably means the S&P is going down and vice versa. So the S&P has been going up as the dollar's been going down, and that's what's been helping stocks to rebound. And then S&P to oil, neutral right now, where they had been going in opposite directions. We're seeing that correlation start to shift. The S&P 500 of the 10-year yield just coming out of neutral territory and a slight tendency to go in opposite directions. You can see we've been coming down with the 10-year yield as the S&P has been going up. And the 10-year yield to tech going back up a little bit here after the 10-year yield had been declining overall. And so a slight tendency to go in opposite directions and more of a tendency to go in opposite directions in the short term. This is the S&P to the 2-year yield. The S&P has been going up as the 2-year yield has been going down. Long-term monthly charts here looking really good when we look at the NYSE composite monthly chart. But we are going down with the Copic curve, which is a momentum oscillator. Another monthly chart, we're going up for the most part here with the NYSE record high percent index. Then we look at the S&P, longer term, still above the moving average, and we're going up with the percentage price oscillator. Longer term, that's still holding up and looking positive there. We're looking good here with the S&P monthly chart above, but when we look at longer term, kind of what we're seeing before, the S&P stocks are underperforming a longer term chart of commodities. And then another US to global measurement here, longer term still holding up. Now we've been coming down, but we're still above this advancing moving average, and the KST, a momentum oscillator, continues to decline. So then at the very end, and I'm not going to read all these off, I blabbed enough in this video already. Pretty much everything that we follow is still positive. The only thing that's negative on the next slide here is the dollar. And so we're seeing some subtle shifts, but not longer term shifts in some of these relationships that we follow in this video. Thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.